What if I told you you can own this building, you can own this skyscraper, and these casinos? Hey there, it's D. Today, I'm tackling another investment vehicle. This time, I want to talk about real estate. A large part of the reason I was able to retire early is because of my direct investment in rental property. I know there's a lot of people that may not have the down payment to get into owning property. They may not want to deal with tenants, and they may not want the responsibilities of owning property. So another way to invest in real estate is by investing in REITs, Real Estate Investment Trust. You can buy, hold, and sell hard real estate while investing in REITs, while home prices are going through the roof, while there's bidding wars going on in almost every state. And actually, I should stop saying state because REITs are available to all of us because these are global companies. Like I said, these companies are global and they are all over the world. You can find REITs that invest in properties on each and every continent. So wherever you are, this type of investment vehicle is available to you. The big question is, how can you invest without a hefty down payment? Let's start with the basics. A real estate investment trust, or REIT, is a company that owns and often manages income-producing real estate, ranging from apartments and warehouses to self-storage facilities, malls, and hotels. It's a way for investors to tap into commercial real estate without the complexities of property management. REITs were established by Congress in 1960. REITs enable investors like you and I to buy shares in commercial real estate portfolios without having to be super wealthy. REITs have become a popular and accessible way to diversify your portfolio and generate my very favorite, dividend income. They are traded on the market just like stocks, allowing you to buy shares and enjoy ownership benefits. One major perk is the dividend-based income. I mentioned the dividends because REITs are required to distribute 90% of their income as dividends. Forget about the need for a huge down payment. Simply buy shares of a REIT and you're exposed to very lucrative real estate assets. Here are some of the benefits. Number one, dividend-based income. REITs have consistent payouts due to their 90% income distribution rule. Number two, they have low capital requirements. There's no struggle to come up with a down payment. With REITs, all you need is enough cash to buy shares, and you can even opt for fractional shares with platforms like Fidelity, Vanguard, Schwab, and even brokerages like Robinhood or Webull. The third benefit is diversification. REITs naturally diversify your portfolio by introducing real estate as an asset class. You can diversify even further by buying different REITs in different industries. The fourth benefit is liquidity. Unlike physical real estate, REITs offer high liquidity. What that means is if you need quick access to your investment, no problem. There are buyers and sellers in the market that are ready to trade REIT shares, so you can get in when you want and get out when you want. Hit that like button and subscribe to my channel if you're getting any benefit out of this type of information. Now let's get back to these REITs. There are also risks. There's property-specific risks. Different REITs carry different risks based on their property focus. Hotel REITs, for example, are more sensitive to economic downturns, as seen during the pandemic or with rising interest rates. Another risk is dividend taxation. REIT dividends might not enjoy the tax advantages of qualified dividends, potentially leading to higher taxation rates. Another risk is limited appreciation. This is due to significant income distribution. The growth potential of REITs may be limited compared to other stocks because of this. Remember when I said that REITs had to give out 90% of their income in the form of dividends? That is what will lessen your appreciation versus another stock. There's also market risk. REITs are not immune to market fluctuations, as evident in the 2008 housing recession and the 2020 pandemic-induced market turmoil. So now, let's talk about how to analyze a REIT. When picking a REIT, consider factors like the company's longevity, consistent growth in funds from operations, competent management, and how the company structures their lease agreements. Do they have triple net lease agreements or some other form of lease agreement? Alternatively, if you don't want to do any of this research, you can go the ETF route. Invest in a REIT such as Vanguard's VNQ, which provides exposure to a multitude of REITs and diversifies your risk. Now that we have covered all of that, I'm going to give you a few options to consider and look into. When I say look into, I mean do your own due diligence. There are at least 240 REITs, so this is just a small sampling of companies that you can consider for your own portfolio. The number one company that we'll cover is Realty Income, ticker symbol O. This takes the spotlight as a top choice among many REIT investors. They are known as the monthly dividend company. Realty Income is a dividend aristocrat, and they have increased their dividend for the past 29 years. They have a market cap of $42 billion and a dividend yield of 6.02%. They pay $3.07 per share annually. Realty Income Corporation manages 13,000 properties. Some of their clients are CVS Health, Walgreens, Walmart, Dollar General, and Dollar Tree. As I mentioned earlier, some of these companies are global. More than 10% of Realty Income's tenants are in the UK. The diversification across thousands of properties and reputable tenants adds to its appeal. Because they've had a pretty significant pullback in the past 2 years, they have a negative 17% 5-year growth rate. They've been down, so they are actually on sale right now. With Jerome Powell and the Fed just signaling that they are holding interest rates where they are and may reduce them in the months to come, Realty Income should benefit from lower interest rates and be on a rebound. Next up, our company number 2 is American Tower Corporation, ticker symbol AMT. American Tower is a giant in the infrastructure property sector with a market cap of more than $100 billion. They are the largest cell tower company with customers like AT&T and T-Mobile. Managing over 183,000 multi-tenant communications real estate properties globally. How would you like to have this job? This company's size and their track record make it a good option to consider. This is a defensive company stock because we can't go without communications. We will always need video, data, and voice services. And for this reason, they are also recession-proof. Their dividend yield is 3.53%. They pay $6.48 per share annually. AMT has shown a positive growth rate of 21% over the past 5 years. They have beat the market in each of those years. Company number 3 is the most exciting of them all, VICI Properties. Ticker symbol VICI, VICI. VICI is an experiential REIT owning iconic gaming, hospitality, and entertainment destinations like Caesars Palace, the Mirage, the Venetian, and MGM Grand. VICI is the biggest landlord on the Las Vegas Strip. You might also be familiar with one of their properties if you golf. One of their golf courses was designed by Jack Nicklaus. They have a total of 4 golf properties. Or if you bowl, you may be familiar with them. They have properties like Bolero, AMF, and Bowl America as their tenants. With a market cap of $36 billion, a current price of $29.15, and a robust dividend yield of 4.52%, VICI has seen impressive growth of 35% over the past 5 years. I'm going to give you one more as a bonus. Company number 4, Prologis, ticker symbol PLD. Prologis operates in the industrial space, managing warehouses and industrial properties. This is an indirect way to get exposure to the e-commerce sector. Prologis benefits from the growing e-commerce sales, currently accounting for approximately 25% of all retail sales. The company emphasizes that e-commerce tenants utilize 3 times the logistics space compared to brick and mortar properties. Some of their customers are Amazon, DHL, FedEx, and BMW. As e-commerce continues to grow, Prologis is set up for substantial growth. Some of their other customers and tenants are XPO Logistics, Home Depot, and UPS. Their dividend yield is 3.3%. Over the 12 past months, Prologis' shares have pulled back 3%. Even though they've pulled back recently, PLD has a very nice 5-year dividend growth rate of 63%. Okay, so that's it for now. Whether you're looking to spend $10, $100, or $1,000, REITs offer a viable path for you to get into real estate investing without breaking your bank. I hope that you got something out of this. Do me a favor, like this video, subscribe to my channel, share it with your friends, and leave me some comments. I love hearing what's on you guys' mind, and the back and forth energy makes me feel like I'm doing something worthwhile. I will catch you in the next video, and happy investing. Talk to you.